Hey, in today's video, we're talking about reverse mortgages. So before you just skip to a different video, you're going to want to listen to this. Now, it is about a 30-minute video, and so you might want to save it till you've got some time, but your equity in your house can play a vital role in your retirement. And so ignore this at your peril. You may want to stick around and watch it. So my name is Mel Stubbs. Stick around. So today we're going to be talking about reverse mortgages. I've got Harlan Akala with us. He is an expert. He's a professional. We'll see which compliance lets me put in there, whether it's going to be professional or an expert in reverse mortgages. So welcome. I have got some questions for you.
Glad to be here this morning.
Let's see. So I did not really know a whole lot about reverse mortgages, and what I did know is not that great. So if you could help us, what are some of the best features of a reverse mortgage, and how does that help us with retirement planning?
Well, Mel, the biggest single thing is that that people need to think about before anything else is that 80% of baby boomers have a house. 80% of people in retirement have a house. And so they've got an asset that they can use. So really the best feature of a reverse mortgage is you convert equity into cash, because equity is worthless and cash is valuable in retirement. You can't do anything with equity. So the first thing that people need to understand is it's really for everyone who is in retirement, who owns a house or wants to purchase a house to live in for the rest of their lives. And the reason that it is such a great thing is because we can actually use the word guarantee and safe, which is something that can't often be used in a lot of investments in the investment world, period. But we can guarantee people that they can live in their house until they're 150, as long as they just pay their property taxes and their insurance. We can guarantee that they will never be upside down. This is a non-recourse loan. Perhaps that is, if there's any feature that we have to pick one, non-recourse, meaning once the loan is in place, nothing can change the ability to live in the house, the ability to receive the funds, the ability to have the line of credit available. That is so important for people to understand, is that when it comes to retirement, somebody said, there's no do-overs in retirement. Mm-hmm. And that's certainly the case. There's no do-overs when it comes to making a poor decision. And a reverse mortgage allows you to have access to some of the money inside of your house without ever having to worry about paying it back, without ever worrying about being upside down, and without ever worrying about having to move. The surety and the safety. One person said to me, I just think reverse mortgages are risky. I said, well, I think that forward mortgages are risky. You got to make a payment. And I think it's risky to have a whole bunch of money in your house and not have access to it. That's far more risky. And there is no risk in a reverse mortgage because you can never be upside down. You can never be kicked outside of the house. The only risk is that you need to understand it. And a lot of people just don't understand it. And so naturally, people are afraid of something that they don't understand. I had my grandkids this weekend. And as soon as you bring something up, I don't want to do that. Well, do you know what it is? And before you say no, make sure you know what you're saying no to. So long answer to a short question, but a lot of different features and the versatility. I should bring up that you can take a lump sum, you can take a monthly check, or you can set up a line of credit. So you decide how to use the funds, just like you do with traditional investments. You decide how to take the money out and when to take it out.
So what are some of the misconceptions people have about reverse mortgages that are not correct and are probably a roadblock for someone to even entertain the idea of a reverse mortgage?
The number one misconception is, I don't want the bank to own my house. I don't want to lose my house. I spent my whole life trying to pay this house off, trying to build this house and remodel it and take care of this house. And now the bank is just going to take the house away. I constantly explain to people, we don't want your house. We are lenders. We're not landlords. No bank is in the business of wanting to take people's house over. That's usually a failure of underwriting or something went wrong. So the bank does not take your house. We put a lien on the property to be paid back in the future, but that lien does not constitute ownership. When you pass away, your children or your estate or your trust or whatever continues to own the house. There's just a lien that needs to be satisfied, just like there is with a forward mortgage. It's really no different. So that's the number one misconception. I think the biggest thing next to losing the house is that I'm going to lose equity. Okay, I understand that my house I won't lose the deed. But I'm still going to lose equity. I've spent all of this time building up equity. Well, that's like saying, well, I've spent all of this time building up my IRA. I can't take any money out because I want to keep it in an IRA and I'm going to give it to my kids. Very few people ever say that. But a lot of people say, Mel, I've got this house paid off and I'm going to give it to my kids when I die. Do your kids want your house? They'd probably rather inherit a Roth IRA or a life insurance than they would a house. But that isn't something that's really talked about and something that is often forgotten in that situation. So the fact that, yes, you are going to lose equity, that is true. But if you take money out of your investments, you will lose cash. So I saw a sign outside a church a long time ago, and it said the cost of living is high, but it's still extremely popular. So think about that. You got to get money from somewhere. Either you got to go back to work, you got to draw Social Security early, you got to take money out of your IRA, your annuity, your pension, whatever the situation is. So one way or another, you have to spend some money. The research overwhelmingly shows that if you take money out of your house first, before you take money out of your other investments, that you will have a better retirement with more cash flow, lower taxes, and actually a higher net worth. So you'll die with less equity, but with more cash, and you'll have been able to spend more money during the time that you were alive.
Well, you've got a 3-bucket income fund illustration. Is that something you can share with us to show how some of us might be missing, including home equity in the planning?
I sure can. That's a slide that I use more than any other slide that is just really important. And if somebody says you only got 5 minutes to explain a reverse mortgage, I will always go to this slide. It's also a chapter in my book that I'd be happy to share with anyone listening to this podcast and this recording. Everybody who owns a house has 3 buckets of wealth. Bucket one is the client's bucket. Bucket two is the financial advisor's bucket. And bucket three is our bucket that we manage. Everything belongs to the client, but bucket one is the client's ability to make wages and commissions, earn money from a business when they take pensions or Social Security or whatever. That's their bucket. And that generates income. And bucket two is everything a financial advisor manages, from 401ks to stocks, bonds, annuities, life insurance, IRAs, 403bs, 401ks, et cetera, et cetera. So bucket three is a client's home value and equity that they have after their loan is paid off or partially paid off. So when you think about the life cycle, the top wallet is when we are young and we're earning money, the accumulation years, as it's referred to by advisors. So bucket one, people make a lot of money during their lifetime. Even people making $30,000 to $40,000 a year make $1 million. So that all goes up to the top wallet. And most of it evaporates right off the top. And people spend it on food and clothes and cars and kids, something called the cost of living that we addressed earlier. But they try to give financial advisors somewhere between 5 to 10% of their income. The national savings rate is only 5%. But people with more money or more foresight put more into bucket two because they want a bigger nest egg when they retire or when they're forced to retire, whatever the case may be. But we take a tremendous amount. In the first of every month, we take almost 30% of the average person's income that flows into bucket three. That's their house payment. And yes, they get a place to live out of that, of course. But the average mortgage payment now is 29% and rising because of interest rates being up and home values being up. That's how much money comes out on the first of every month and pours into bucket three, which dwarfs the amount of money going into bucket two. So as a result, as I mentioned earlier, that's why there's $14 trillion sitting in bucket three, because it's a forced savings plan. People have to pour money in there because if they don't, they get kicked out of their house. I always tell financial advisors, hey, tell people that they're going to get kicked out of their house if they don't put X amount of dollars into bucket two. And people put a lot more money into bucket two. So it's a very much a forced savings plan. So now let's take that all the way to the end. Somebody turns 62, 65, 67, whatever. They decide to retire. At 62, you're eligible to take Social Security. At 65, you're eligible for Medicare. At 72, you have to take money out of your IRA and RMDs and so on. But at 62, you are allowed to take money out of your house tax-free. And in addition to it being tax-free, it is also money that does not have to be paid back ever. So when you get down to the 62-year-old bracket, you can look at Social Security in bucket one. They can walk into your office in the office of a financial planner and say, I want to start taking some money out of my 401ks or my annuity. I want to turn on my annuity, whatever the case may be. But they rarely walk into our office and say, hey, I've been giving you guys money, 29% of my income for the last 40 years. I'd like some of it back, which kind of defies common sense. Why would they not ask for some of that money back? Well, because they're scared of it and because they don't know what it is. And so it has proven, and I really took this information from and just put it into a simple form from lots of smart CFPs, CFAs, PhDs, researchers that have spent years and years putting Monte Carlo simulations together. And what they have proven is if you use this three bucket strategy, instead of only concentrating on bucket one, Social Security pensions, and bucket two, the nest egg, that three things will happen. And those three things are right here. Their cash flow will increase, which is obvious. You're pulling from another bucket. You will decrease income taxes, which a lot of people don't realize because of the fact that you can get deductible interest off from a reverse mortgage. But more importantly, all the money you pull out of a reverse mortgage is tax-free, kind of like a Roth. And the biggest thing that has been proven with thousands of Monte Carlo simulations, Mel, that people don't even realize is it increases net worth and thus legacy or spending while you're alive. That was the big shocker, because if you start pulling money out of bucket three first, bucket two is more efficient and grows, continues to grow. And then, like right now, when the market has dropped, you can pull money out of bucket three instead of bucket two, and you don't lock in losses to avoid sequence of returns risk. So all those things work together that if you incorporate bucket three, and a lot of people don't have to, I don't have to have bucket three activated because I'm still working and I can afford to make mortgage payments. But I did at 62 because I want bucket two to be more efficient and I want to put more money in bucket two and less money in bucket three. And that has been proven mathematically. You know, somebody came to me once at a conference and she said, I'm going to skip your keynote and I'm going to do my emails because I don't believe in reverse mortgages. And I said, well, ma'am, this is not a faith-based product. This is a math-based product. If you believe in math, you're going to want to come to the seminar. And she did and continues to use it as part of her practice. But the bottom line is, if you just look at the math, the less money that you continue to pour into bucket three, or the more money you take out of bucket three instead of bucket two after you turn that magical 62-year age bracket, the better off you'll be. Doesn't mean you have to do it. It just means that it's more efficient as you're going through. So this diagram, as it goes together, many financial advisors use it, many clients use it, and most financial advisors take bucket two and they break it down into a whole bunch of other buckets: a tax bucket, non-tax bucket, short-term, long-term, and so on. But the basic idea of pulling money from bucket three, instead of just pulling the money from bucket two early in retirement, makes a dramatic difference, and it's huge. It's usually not just a little bit of a difference; it's a big difference.
So a couple, I guess, things I'm pulling out. You tell me if I'm right or wrong. On bucket three, if you have a mortgage payment, but you have enough equity, you could do one of these and it eliminates the mortgage payment and would help with cash flow.
Yes. So a lot of people get confused in reverse mortgages. And even if they think they're okay, they say, oh, that's where you get a monthly check. That's actually the least common way that a reverse mortgage is used. The most common way that a reverse mortgage is used is, number one, to eliminate an existing mortgage payment. That's what I did. At 62, I still had a $3,000 a month mortgage payment, almost. And so I stopped making that mortgage payment and instead sent that money to my advisor. And over the last 3 years, sure enough, my tax bill went down and my net worth went up and my cash flow went up because I eliminated that mortgage payment. And so all you have to do is have paid down more than 50% equity, usually 60 to 70% that you've paid down, and then we eliminate that mortgage payment and take it to zero. Most people think the only way you get a mortgage payment to zero is to pay your mortgage off, which is the most inefficient way to do it. Most efficient way to do it is get it down to 30, 40, 50%, depending upon your age, and then flip it to a reverse mortgage, which has optional payments. And you can make payments if you want, but you don't have to. And that is really the significant difference.
And so for some of the people that realize they have equity in their house and so they go set up a home equity line of credit, thinking
Mhm.
that, hey, this will be my emergency fund or whatever. What are some of the drawbacks of that, and why would a reverse be better?
That is probably one of the most common questions that I get from people that are in retirement. And they say, reverse mortgage is more expensive. You got to pay that insurance fee and everything else. I would be better off. I'm sure that I would be better off. Just take a cheap, quick line of credit out of my investments or out of my house. Why don't I just go to the bank and get a line of credit? It costs me like $300 or nothing or $1,000 or whatever. I always tell them if you're 30 or 40 or 50 years old, smart idea. If you are 62 plus, it is almost always a very foolish and dangerous idea. And here's why. There's three problems with regular lines of credit in retirement. Number one, you have to make a payment. And people say, well, of course, but I can afford to make a payment. Well, can you or do you want to over a long period of time? Because as the interest rates go up and down, your payment goes up and down. A lot of people have seen their payments increase by 3 times if they took out a line of credit back when rates were 2, 3%. So now, number one, your payment can go up and you don't have any control over that. And then it goes into repayment within a 5 or 10 year period of time, increasing it again. Some people are dealing with 5 times the amount that they have to pay back right when it's a difficult cash flow time in retirement. So that's number one. Number two, this is something that a lot of people don't realize and there was a lot of research done on this with Harold Avensky and Texas Tech University back about 10 years ago after the 2008 crash, because he told a lot of his clients to get a reverse or a regular traditional line of credit instead of a reverse line of credit because he didn't know about reverse lines of credit, and that's where the research came in. And here's what he tasked Texas Tech University financial planning department to do: go look for a line of credit that cannot be canceled if the market goes down. There are none because every traditional line of credit, every forward mortgage line of credit, HELOC, whatever it's called, whether it's a small bank or a big bank, has a clause. And that clause is simple that if the bank deems itself insecure, they can cancel, freeze, or demand repayment of the line of credit. And that's universal. That's in all of the mortgage documents, the ones that Movement Mortgage does where I work, the ones that JP Morgan Chase has, the ones that Wells Fargo has, or the local bank or credit union. And they all have that same clause. Just ask them, do I ever have to pay this back if the market gets bad, if my house value plunges, if my wife dies, if I die, what happens then? All of them can be called or canceled. And many billions in lines of credit were closed and canceled after the 2008 crash. It was a horrible situation for many people that needed that money, that wanted that money to be able to make it to the next level. So, really, that second reason is the number one reason not to have it. You don't want an umbrella that you get when it's the sun shining, and when it starts to rain, it gets taken away. That's exactly when you want it and need it. And here's the third reason. Traditional lines of credit tend to go down. The amount that you can use goes down during the time period that as you get older in retirement, because your income goes down and you requalify. And they say, what's your income? Well, maybe your income was 250,000 when you were working, and now it's 50,000 with Social Security. They can decrease your line of credit no matter how good your credit is. If a spouse dies, they can decrease the line of credit or take it away. A reverse mortgage is line of credit is guaranteed, and we can use that word guaranteed because it is in the mortgage document. It's guaranteed to go up by the current rate of interest, regardless of what happens to the economy, the value of the house, whether or not people are sick, whether they pass away, one person passes away, whatever the case may be. That line of credit is going to continue to go up. So if you start with a $200,000 line of credit when you're 62, under current interest rates, you're going to have a $400,000 line of credit by the time you're 72, an $800,000 line of credit by the time you're 82. So that is a huge, important scenario. Some financial advisors refer to it as buying a put on home equity. You're getting a guaranteed future value regardless of what the value of the house is. So those three things: no payment, guaranteed never to be taken away, and thirdly, guaranteed to go up, does not even compare to any other lines of credit out there in the market that are really, I would say, well, those are for young people. But for us older people, we want safety, we want guarantees, we want a zero payment. And those are the main reasons.
And on our channel, we talk a lot about Roth converting and tax planning. Pretty much everybody here is a federal employee, retiree, where they've got a pension, Social Security. I mean, they've kind of got some guaranteed checks. Are there any strategies using reverse mortgages that can save on taxes or that would allow income to be lower to have more room for Roth converting? Like, how could this work into our Roth converting strategies?
Yeah, I've worked a lot on the Roth conversion numbers with Money Guide Pro and eMoney and all the software programs out there. And the answer is always the same. It's not, again, that's something that's not complicated. If you use your portfolio to pay for the Roth conversions, you will always end up worse off than if you use the house money to pay for the taxes. So if you're converting $500,000 and your taxes are 100, and you're going from a traditional IRA to a Roth IRA, and you go down from 500 down to 400, and probably worse depending upon the state that you're in, at that point you've lost 100, and it takes a long time to make that 100 back up. But if you take that out in December, that 500,000, and put it into a Roth, all of it, and then when April 15th rolls around the next year, you pull that money out of your reverse mortgage, tax-free, then that 500,000 in your Roth continues to grow. You don't have to recover that 100,000. So yes, you have less equity in your right pocket, but way more cash in your left pocket. And that is the fundamental scenario. You can run all kinds of different software, use your reverse mortgage to pay for the Roth conversion, not the investment itself. Makes a dramatic difference. And then some people say, well, yeah, but what if you do what you talked about earlier and you're just converting a regular mortgage into a reverse mortgage? Then you don't have as much money to pull out of your house. Well, that's my situation. And so what I did in my situation is I said, okay, I'm going to convert my regular mortgage into a reverse mortgage, and then you're allowed to deduct that interest when you pay it. Well, just this year, like a lot of my clients, I took out $100,000 out of my IRAs, paid it into my reverse mortgage, and got 100% tax write-off on all of the interest that had built up for the last several years. So you only pay your interest when you're way above the $30,000 standard deduction. If any of your clients would like to see that, I wrote an article for NASDAQ.com a number of years ago that kind of covers this as a kind of a 2-3 step strategy. But the ability to deduct that interest saves, like just this year, I saved personally and many of my clients over $30,000 in 1 year on actual taxes paid. I didn't defer them. I actually continued to have that money that is completely now tax-free, inside of a Roth or outside of a Roth, but it's no longer taxed because it's outside of that traditional IRA, which a lot of people worry about having a mortgage on their house. They should worry about having a mortgage on their IRA. I just talked to somebody that had a $2 million IRA. I said, do you realize you have a mortgage in your IRA? And they said, no, we don't. We haven't leveraged any of our IRA. I said, well, how much of that is yours and how much is theirs? And they said, well, it's all ours. And I said, no, theirs is spelled the IRS. And the IRS.
No, so right here, no longer theirs. It says the IRS.
Oh, I like that. That's
We're
good.
on the same boat.
So if you have a mortgage on your house, it's much more palatable than because we can give you an exact number of what you owe. The government cannot, because they'll say, well, we might want more next year. We might want more if you make more money. They'll decide how much they want. And so they have a mortgage on your IRA. I'd rather have a mortgage on my house because it's much more predictable. And I'm in charge of the contract and I'm in charge of when I make that payment, not the other way around.
Trying to recap on some stuff. So a reverse mortgage could be an emergency fund that's there. The way the reverse mortgage is set up, the fund each year will be getting, the balance available will be getting higher. So in the later years, if something bad happens, you should have, or I guess you're guaranteed to have a larger balance.
You're absolutely guaranteed that the balance continues to go up no matter what, until you use all of it. Then the balance continues to go up, but it's going up to pay the interest.
And so the balance keeps going up, and you should have more money available later. Hopefully the house value keeps going up. And when you do die, there is still equity there for your kids. But if there is not equity, FHA steps in, covers the rest with the mortgage insurance you've been paying. So you cannot be upside down.
That's something that probably should be repeated over and over, because everybody, some people say, like myself, I'm a big believer in the 7 habits of highly effective people. And one of them is begin with the end in mind. If that's where we want to end up, then what do we got to do today to end up there? So a lot of people say, this is great, but it probably does not end well if there's a crash and you die in the wrong year. This is guaranteed to end well no matter what. I once in a while I go to Las Vegas for conferences, and I'm not a gambler. I think the most I've ever bet is maybe $20 or something like that for fun, and it quickly got ate up by those vending machines that don't give you anything back. But anyway, I was thinking, and when I was in Las Vegas one time, if there was a casino that had a big sign out front that said you are guaranteed not to lose, that's a casino I would go into, and I'd spend a lot of time there because I'm not guaranteed to win, but I'm guaranteed not to lose. I mean, that's a big deal. And so when you are guaranteed not to lose, if things are great and home values are going up like they are now, nobody's upside down in their houses now, but many people were upside down if they died in 2008 to 2010. So the bottom line is if I'm guaranteed that I will never lose, and if it's bad, the bill goes to FHA, and if it's good, the money goes to my kids, or back to my trust. Well, why would I not do that? Because I'm guaranteed not to lose. And so it's such a significant thing that people have to be aware of the safety that's involved in a situation like that. And why not take advantage of that guarantee? Because it's guaranteed in writing. It's not guaranteed by mortgage guarantees it, but it's guaranteed by the Federal Housing Administration. So as long as the government doesn't go out of business, and China takes over or whatever, well, then we got a lot of things to worry about besides reverse mortgages. But as long as that's in place, no matter what, we have zero worries about whether or not we are going to leave a problem behind for our children. And that is something that virtually everyone has the concern about.
And I've got here your book. If people want it, tell us about where can they get it?
Well, you can buy it on Amazon for $20, or they can contact you, and I'll just send you a big stack of books, and you can get it over to them. So for free.
Awesome. Anything else we should know, or are we all good?
Well, the last thing I'd like to mention is a shameless commercial, and it's not really a commercial. I work for a company called Movement Mortgage, and Movement is very different because we give away half our profits. We've given away, and we've been in business for 15 years. We're one of the top 10 mortgage companies in the nation. And there's a lot of mortgage companies that can do a mortgage forward or reverse. But the cool thing about a Movement Mortgage is that we help a ton of people that are less fortunate than us. And we've done that to the tune of $400 million in the last 15 years. And we want to continue to do that. And every time people do business with us, they're actually helping a child in Guatemala, or a community that is struggling over in Africa, or kids that need education right here in our inner cities. And we do a lot across the country to do that. And we appreciate people joining in our mission, not only to do business with us, but to help many of those, because our motto is that we exist to love and value people. And we appreciate that when we can love and value our clients, and then it also turns into loving and valuing others that are less fortunate across the world.
Hey, thanks for tuning into this video. I hope you got some value out of it. If you need some help, go to christycapital.com and click Talk to an Advisor. We would love to help you. If you want to watch another video on your federal retirement, just check right here. My name is Mel Stubbs. Go to our website, christycapital.com. I'll talk to you soon.